What would your advice be to someone who is managing their own finances, who is taking care of their investments, who's paying off, say, loans, or putting money into SIPs? Uh, I'm just going to go through the different categories and ask you what you think they should be doing now. So, first of all, is this a right time to look at all your investments holistically and say, okay, I need to pull out of some places, put more money in other asset classes, or should people just keep doing what they're doing?
I think if you have a balanced portfolio, first of all, uh, having a multi-asset portfolio in such times, in these volatile and turbulent times, becomes very important when the inflation is also uh, high and interest rates. Central banks are not cutting interest rates, but they are rising interest rates. So it's a double whammy for investors. So have during such times, having a multi-asset portfolio is very important. You have different categories. So each asset class plays an important role in a portfolio. For example, equities over a long run, you might see that they are a good hedge for inflation. In a shorter time period, like we are saying, the inflation is high and equities are also very choppy. But over period of long term, say 5 to 7 years, inflation equities are good hedge for equities are good hedge for inflation. And then coming to fixed income, they provide stability in the income, capital preservation, and steady growth of income, and somewhat cushion the portfolio as well in such turbulent times. And then we can say having gold is also very important. We can see in geo uncertainty in geopolitical conditions like one we see in March and April, and we're still going through it. Gold was a very good diversifier in the portfolio when seen like war happens. So I think one should look at if they have a balanced portfolio or not, and then continue whatever they are. If you have a balanced portfolio, then you should
Right.
not stop your investments or anything, but should continue, because your horizon is long. You should
Right.
not look in short term, but look from a longer term perspective.
Okay, so we're now in the last few months, we've seen the RBI has been hiking interest rates and banks are passing that on down to their customers. So, in the last month, fixed deposit interest rates have gone up a little bit. They're still much below the annual inflation rates, which means your actual return is still negative if you put your money in a fixed deposit. But if you don't do a bank fixed deposit, if you're doing like a corporate fixed deposit, there are yields that in some cases go up to 7.7%. So is it a good time to maybe put some money into a corporate fixed deposit or look at a long term bank deposit? Should you? What is the call on interest rates that we should take?
So basically, central banks, are still in a rising interest rate mode. They are, as I said, that inflation. It's too early to share that we are past the high inflation era. The inflation era is still there, and due to that, there is a very uncertain economic environment, interest rate environment across the globe, and it depends a lot on what happens from what is the outcome of Russia-Ukraine war going on? How long will it last? And all that. So I won't say that we are. It might be pull out your money from fixed income and put everything in corporate bonds. We are still in a very uncertain rising interest rate environment. So it's we should follow a balanced approach. In fact, interest rates, as RBI raises interest rates, bank deposit fixed interest rates for the bank deposits are also going to rise. So it's investors should follow a balanced approach rather than just looking at one over the other.
Okay. What happens to equities when interest rates are rising, not just in India, but also interest rates are rising abroad? For instance, the US Federal Reserve Chairman says he wants to stamp out inflation altogether. So the US has been increasing interest rates, and that affects the inflow of foreign investment into Indian stock markets. So, what is that effect from there? What is the effect from domestic inflation? Are we seeing any slowdown in investments in the markets? Are so retail investors in India, are they behaving differently now?
Not really. Actually, we are seeing a very positive development when it comes to domestic investments from retail. So you can see the first 6 months of this year, when there was a lot of geopolitical uncertainty and foreigners pulled a lot of money, huge amount of money from Indian markets. And it was then domestic investors who came to fill in the void, and it could cushion the fall in equity markets. So we are seeing a very good positive development. Traditionally, Indian household portfolio is like it used to consist of real estate, fixed deposits, gold, etc. And now they are, adopting and embracing equity as an important asset class in their portfolio as well. So we are not seeing any kind of slowdown in retail investment from the retail investors. In fact, we are seeing more interest from the retail investor side. So, and that is a very positive development, because as I said that equities over a long horizon is an inflation beating asset class. And we as a country still have a very less proportion to an allocation to equities in an average Indian household portfolio. So equities, it's a good development. We are not seeing any kind of slowdown. In fact, SIPs have tripled over a span of 5 years.
Hmm.
So, but you will see in a rising interest rate environment, in a rising inflation environment, you would see that equities are very choppy, and in these are the times when you will get attractive valuations for the equities. We have already seen that back in June, equities were at the attractive valuations, and from there we've almost risen by 17 to 20%. So these are the times when investors should incrementally think of putting money into equities rather than kind of shying away and stopping their SIPs.